Our next guest says rising rates are here to stay, but you can still buy stocks. Which ones? Let's bring in Julian Emanual, Chief Equity and Derivatives Strategist at BTIG. You get a warning like PPG, and you piece that together with Pepsi, all these other companies that have come out so far. Does that cause you concern that we're going to start hearing on these company conference calls the impact of higher input costs, the impact of tariffs, the inability perhaps to pass price increases to a consumer?
No question about it. You are going to hear these things, but as you discussed moments ago, you're actually setting up soft into the reports. And unlike, a market that was ramping into prior earnings season reports, that's a good setup. But it's absolutely going to be an issue. And if you look at it, it's really not conclusive whether the tariffs are inflationary or disinflationary. It's this constant tug of war. And I would suggest that the move higher in rates is due to a lot of other things, one of them being a lack of demand on the part of international investors. But the point being that unlike the last move over 3%, this one has staying power, and the yield curve steepening as a consequence is part of the reason why. And for us, that is a green light for financials and energy.
For financials and energy, but how about the rest of the markets? I mean, is this ultimately, do you see the longer term trend, which is rising rates usually positively correlated with stocks, or the reverse happening?
That could change eventually, but for that to change would take the impact of the trade war to be inflationary, something just sort of more longer term in nature. And we just don't know the answer to that yet. And that's why corporate commentary in the upcoming earnings season is going to be very important to listen to.
You talked about maybe the head fake on rates. Maybe this is about foreign buyers stepping away, Treasuries refunding twice as much going into next year than they were 2017. Could rates higher just be a technical dynamic right now?
We don't think so. So if you look the next several weeks, we have come a long way in the 10-year, and it wouldn't surprise us at all for sort of the pause that refreshes, as it were. But really, when you look at the bigger picture, the bigger trend, and you talked about double tops and double bottoms, if you look back over the history of 10-year rates, there is a momentum double bottom that would indicate, the bigger trend has changed to higher rates.
Julian, about energy, I mean, energy has the highest revision rate up among the bottoms-up analyst community and the highest price target differential between current and where people believe it. And yet it's been all PE contraction all year. The most of all the sectors, the most multiple contraction has been in energy. I'm sort of surprised how poorly it acts given we hit 85 a barrel in Brent, 75 in WTI, and still the energy is not really coming to life.
There's definitely a skepticism around the staying power of higher oil prices. But, the fact of the matter is that the geopolitical situation would lead you to believe that there is a staying power to it. And to your point, Carter, the composition of energy in the S&P 500 index continues to be near all-time lows, sort of 6.5% versus 10% average. So you could get a really big rally, and we think that's part of the story in a market that stays essentially flat.
So are you worried, though, about forward earnings revisions lower? If you think about all these input costs going higher, we know where oil is, we know where the dollar is.
Labor.
We know where labor, we know where trucking. Pepsi said this last week.
Credit's more expensive.
Credit's more expensive, so financing all this debt, and then the inability to kind of, borrow to buy back stock. Couldn't you see a legitimate EPS downgrade for 2019 between now and the end of the year?
You could, but the counter to that is that valuations in aggregate are already okay. I mean, you've had multiple contraction in 2018, a couple of turns, and if you're still going to grow close to double digits in 2019, the market can support that. The question is, and I think we talked about this a few moments ago, what's the Fed's reaction function? And the Fed's telling you that there is a reaction function as opposed to discrete forward guidance now. So if things get a little more dicey over the next month or two, we'll see if the Fed steps back. That's supportive for markets.
Are you saying that you think the December hike is in question?
Yes, we have always said that. Our
so even though it's priced at what, 95%? I don't even know what the Fed. It's something like
about
that.
75, 80%.
Okay.
So our view is that they may still hike.
Yeah.
But the probability of their hiking is likely
lower
to come
and
down
lower.
between now and then.
And because of earnings season?
Because of earnings season, because of tariffs, because of midterm elections. There's a lot of reasons to expect volatility over the next couple of months, and it could ultimately end up being upside volatility.
Julian, thank you. Good to see you. Julian
Always,
Emanual,
thank you.
BTIG. You buy what Julian's saying?
Well, to a point, but I mean, I think if the Fed doesn't hike in December,
I think it would freak the markets out.
I think it would freak the market out. So I could understand how you could say it's bearish because, again, you have the Fed put in place. I think the market might knee-jerk go higher, but I think then they'll say, what do they see that the rest of us aren't seeing? I actually think it would be bearish.
If the Fed said that today, that's fine. But I think what Julian is saying, and good for them for getting out there with a non-consensus call on this, is that by the time we get deep into the fourth quarter, you're actually going to have seen, as I've said a couple times, we haven't seen trade data yet because
it's too early.
It's not in the cards. So I like the ability to be flexible on that. The Fed says they're data dependent. Why not?
You know, you said we haven't seen trade data, but we might have seen first half data, like buying of semiconductors, like push forward, right? Like we might have seen a lot of this stuff, and that's one of the reasons when we talk about, well, semis, they sell into industrial, they sell into a lot of different end markets. So, at the end of the day, we may be like looking back and saying, oh, that was kind of obvious. And I'll just say this, that if the market rallies, it goes parabolic, it breaks out because the Fed doesn't raise in December, then we set up like we did last January, where it just everyone's scratching their head, none of it makes any sense, and then before you know it, we're down 10%.
And ultimately, the consumer discretion, the comps are going to get very hard very soon.